March 24th, 2026. Costco drops a 24-pack of Kirkland energy drinks for $16.99, 70 cents per can. 6 trading days later, Celsius Holdings loses $1.2 billion in market value. Wall Street analysts had been calling Celsius the next Monster Energy, a growth stock with strong retail partnerships. What they missed, Costco wasn't just their biggest customer. Costco was learning their formula, and the moment Kirkland launched, Celsius became a commodity that could be replaced by a label that literally says Kirkland. This is the story of how one private label launch exposed a $7 billion mispricing. Celsius closed February 2026 at 53 to 61 per share. By March 26th, 6 trading days after Costco's announcement, it hit $35.59. That's a 34% collapse in under a week. Volume spiked to 17.5 million shares on March 24th alone, nearly triple the normal load, as institutional money bolted for the exits. Analysts had been citing durable pricing power in their models. The market just told them Celsius had zero pricing power. A Kirkland label could steal shelf space overnight, and the stock reflected it in real time. One product launch, one trading week, $1.2 billion gone. In 2022, Costco represented 17% of all Celsius revenue. Analysts knew this number. They put it in footnotes. What they didn't model, Costco was simultaneously Celsius's biggest channel and their easiest competitor. The moment Costco decided to compete, they didn't need Celsius anymore. They had the SKU slot, the supply chain, and the customer data. Wall Street had valued Celsius like it controlled distribution. The truth, Costco controlled distribution, and Celsius was renting shelf space from a landlord who just became their rival. Kirkland energy drinks, $16.99 for 24 cans. Celsius at Costco, roughly $30 for the same count. Costco just undercut them by 43% using the exact same format. 200 milliliters of caffeine, 3 tropical flavors, same 12-ounce can. Shopper reviews on Reddit noted the taste was nearly identical. Analysts had been writing about Celsius's premium positioning. The market just learned it wasn't premium, it was marked up. The moment a customer could get the same caffeine hit for 70 cents instead of 1.25, the brand became irrelevant. Costco proved Celsius was a commodity hiding behind a lifestyle logo. December 2025, Celsius spent $3 billion acquiring Alani Nu, paying 12x EBITDA to diversify beyond energy drinks. By Q1 2026, Alani Nu was contributing $1 billion in revenue, 40% of Celsius's total sales. Analysts called it strategic diversification. What they missed, Celsius just levered up their entire business right before their core product got commoditized. They bought Alani Nu at 3x sales, assuming energy drink margins would stay fat. 6 weeks later, Costco torched those margins, and now Celsius is carrying $3 billion in acquisition debt with a cratering core business. The diversification didn't save them, it amplified the problem. Celsius had a deep distribution partnership with PepsiCo. Analysts cited it in every bullish note as their moat. PepsiCo's trucks delivered Celsius nationwide, giving them access to convenience stores and gas stations Costco doesn't touch. But here's what the partnership didn't do: protect them inside Costco. PepsiCo has zero leverage over what Costco puts on its own shelves. The moment Kirkland launched, the PepsiCo deal became irrelevant for the 17% of revenue that flowed through warehouses. Wall Street valued Celsius like distribution was their moat. The market just learned distribution is only a moat if your retailer doesn't compete with you. February 27th, 2026, 3 weeks before the collapse, Needham maintained a buy rating on Celsius with an $85 price target. The consensus across Wall Street, $68 average target. Their thesis, strong brand loyalty, growing retail footprint, expanding margins. On March 24th, the stock opened at $39. Every single analyst had missed that Celsius's retail footprint included a retailer that could clone their product for half the cost. The average price target implied 100% upside. The actual result, 34% downside in 6 days. This wasn't a miss. This was a fundamental misunderstanding of who had the power in the value chain. Here's what analysts should have known. Kirkland Signature generates $59 billion in annual sales, more than Coca-Cola. When Costco launches a Kirkland product, It's not testing the market, it's replacing the market. They've done this to batteries, to vodka, to rotisserie chickens. The pattern is always the same. Costco identifies a high margin category, reverse engineers the product, launches at half the price, and the branded supplier either accepts lower volume or loses the account entirely. Celsius wasn't special. They were selling carbonated caffeine water with B vitamins, a formula Costco could replicate in 6 months. Wall Street valued Celsius at $7 billion like they had intellectual property. What they actually had was a recipe anyone with a co-packer could copy. The moment Kirkland launched, Celsius became Tower Records in 2001, a brand that forgot it was competing with its own distribution channel. 6 trading days, $1.2 billion in market cap, 1 private label launch. The lesson isn't that Celsius is doomed, it's that Wall Street had valued them like they controlled their own destiny when Costco controlled the shelf. Analysts called it a growth stock with pricing power. The market just called it a commodity. If your biggest customer can replace you with their own label for 43% less, you never had a moat, you were renting one, and the rent just came due.